this session we are learning about what is market value per share upon book value per share. Okay, so basically these ratios are computed for the purpose of your investment analysis, okay, from shareholders point of view. So market value per share is the information which is based on your capital market or share market. So market value per share is nothing but either average sales price per share or closing sale price per share. Okay, so this is what is an expectation of the customer. Okay, whereas book value per share is your value per share as per balance sheet. Okay, so value per, this is actual. So basically this ratio shows what is the ratio of expectation versus the actual. So how much is the percentage of your expectation upon the actual. So how do we calculate a book value per share? Book value per share is equal to your equity share capital, okay, share capital plus reserves and surplus, okay, but this has to be excluding revaluation reserve, okay, minus your fictitious assets, that is what accumulated losses or miscellaneous expenses or preliminary expenses which appear in the balance sheet to the extent it is not written off. Now there is one more approach in calculating the book value of per share, wherein you don't reduce the fictitious asset, okay, you just take equity share capital plus reserves and surplus excluding the revaluation reserve, divide by number of equity shares. Okay, so what is the formula for this? Market value per share divided by book value per share. Okay, now we'll see an example and calculate this ratio. So particulars and the amount, okay, so EBIT 80 lakhs, then capital structure 1 lakh equity share of rupees 100 each, 1 crore, 10% debentures, 2 crores 40 lakhs, reserves and surplus before adjustment of current year's profit 50 lakhs, miscellaneous expenditure and losses 50,000, provision for taxation 50%, proposed dividend is 20%, and closing market price is 170 rupees per share. Okay, so now we have to find out this ratio, that is market value per share upon book value per share. So before calculating book value per share, what we'll do is we'll find out how much is the current year profit to be transferred to reserves and surplus. Okay, so current year's profit to be transferred to reserves and surplus. Okay, because reserves and surplus, whatever balance of 50 lakhs is given, that is before adjustment of current year profit, so we have to add the current year's profit to that. Okay, so first we'll start with EBIT, that is earning before interest and tax, is 80 lakhs. Okay, so less, first we will deduct interest. Okay, so how much is the interest? 10% debentures, so 10% of how much is the value of debentures? 2 crores 40 lakh, so 2 crores 40 lakh. Okay, so that comes to 24 lakhs. right? So 80 minus 24 lakhs is 56 lakhs. Okay, so that is what earning before tax. Okay, now what we have to do is we have to reduce provision for taxation. So less provision for taxation. Okay, how much is the provision for taxation? 50%, right? So it is 50% of 56 lakhs. So that comes to 28 lakhs. So your earning after tax is 28 lakh. Earning after tax but before appropriation. Appropriation is distribution of dividend. Now let's see how much is the dividend. Okay, so proposed dividend is 20%. Okay, and capital structure is 1 lakh, equity shares of 100 each. So 20% of 1 crore. So 20 lakhs. So your proposed dividend %20 of 1 crore, that is 20 lakhs. Okay, so 8 lakh is the profit to be transferred to reserves and surplus. Okay, so now we will calculate how much is the book value per share. Okay, so book value per share is what? Equity share capital plus reserves and surplus excluding revaluation reserve minus your miscellaneous expenses and losses. Okay, so divide by number of shares outstanding. Okay, so equity share capital is 1 crore. So equity share capital 1 crore. Okay, plus you have to add reserves and surplus. Okay, so reserves and surplus, how much is the balance in the reserves and surplus? 50 lakhs. Okay, so 50 lakhs is without considering current year profit. So I'll put it in the bracket here. 50 lakh is a opening balance plus how much is the current year profit? We have got it here, 8 lakhs. So plus 8 lakhs. So that comes to 58 lakhs, right? Minus miscellaneous expenditure and losses. How much is that? 50,000. So we have to reduce 50,000, right? So how much is the total book value? 1 crore 57 lakh 50,000. Okay, now we will calculate what is the book value per share. So book value per share is equal to your total book value divided by how many shares are outstanding? 1 lakh equity share of rupees 100. It's a 1 lakh divided by 1 lakh. So that comes to 157.50. Okay, now your ratio, okay, market price per share or market value per share upon book value per share. So what is the market price per share? It's given here, closing market price 170. Okay, so this is what is the shareholders expectation, 170. upon how much is the book value per share? 157.50. So this comes to 1.079. Okay, so this is what is the ratio of market value upon book value. Okay, so you can see that your expectation of the customers is higher as compared to the actual book value per share. Okay, so that was about market value per share upon book value per share. Thank you.